The Fed raised its inflation forecast for the year, but stuck to its forecast for 2 rate cuts. Joining us now, former Cleveland Fed President Loretta Mester. She's now professor of finance at UPenn's Wharton School and a CNBC contributor. Loretta, great to see you.
Nice to see you too. Thanks.
Did you agree with the Fed's assessment that the base case should be that the impact of tariffs is transitory, that UMISH was an outlier?
I think that they should be taking the inflation expectations moves that we've seen in some of the measures a little more seriously than is suggested in the press conference, or at least the reporting after the press conference. And I think they are. I think in terms of what the Fed did, I think they're right. You know, it could be that the transitory nature of those tariffs are going to be working through the economy just fine. But the potential is that they could disrupt inflation expectations. You see second-on effects, other prices rise, not just the ones tariffed, and that could become an inflationary problem. And they need to balance that off of what else is going to happen in the economy later on, where we could see the uncertainty actually weighing on things more than it has so far. So they've got to be focused on both parts of the mandate and making sure that they do re-anchor inflation expectations or maintain the anchoring if you believe they haven't de-anchored yet, and then think about growth and what the effect of some of the other policies are going to be on growth. And it's not just the uncertainty around the tariff policy, which we're already starting to see some of the reaction to that by both businesses and consumers being a little more wary of spending, right? There are other things coming in terms of tax, cuts that could be buoying the economy and buoying growth later on. So they're going to have to balance both those kind of policies and then set that against the other part of their mandate, which is inflation. So it's going to be a little bit hard to navigate, and they're going to have to keep balancing, and they have to be more nimble than they usually are, because the dynamics here could be different than what they are expecting. So looking at a lot of scenarios is probably the way to go here.
Demanding more nimbleness sounds like it opens the door for more potential errors to happen with the economy. I mean, do you think there's more risk here, than there was, 6 months ago to the economy?
Well, we know that risks have gone up. I mean, there's no doubt about that because of the change that we're encompassing here. And, in the long run, maybe some of the change will be good, but in the short run, it can be very disruptive. And we've seen that already. If you talk to businesses, a lot of them tell me, just tell me what the rules of the game are. I can handle it. The economy's resilient is another way to say that. But if I don't know what the rules of the games are, it's hard to play. So, we're already seeing some of that. And that's what makes this a little bit tricky, right? Because you could have a pause in growth or downturn in growth now. Then you could have the inflation come via the tariffs. And so even if it's not a lasting inflation, you're going to see prices rise because of the tariffs, at least on some goods. And that could feed into inflation expectations. So you could have that combination. That would be difficult to navigate if you're trying to keep your eye on both parts of the mandate and navigate as well in an uncertain environment. And I think that's what the Fed faces, as well as every business and every consumer. They don't really know what's coming, and so they're going to be a little more cautious than they were before.